Welcome back to the Deep Dive. Today, we're digging into Barrick Gold's Q3 2025 earnings call. And there is a lot to unpack here.
There really is. This wasn't just another set of numbers. I think what we saw was a genuine inflection point. Barrick managed to take this amazing gold price environment and really pair it with strong execution.
Right.
And that translated directly into record cash. So the big message coming out of this call is, this company's in a new phase. It's all about cash-backed growth and giving a lot of that cash back to shareholders.
Okay, so let's start right there with the hard data. The headline numbers really set the tone, didn't they?
They were massive.
Revenue came in at $4.1 billion. That's a 23% jump from last year.
A huge jump.
And adjusted earnings per share, the EPS, hit a record 58 cents. That just flew past what analysts were expecting.
It did. And, the adjusted number is what you really want to look at. It gives you that cleaner picture of the core operations.
The core was strong.
Incredibly strong. I mean, production was solid, sure. 829,000 ounces gold, 55 kilotons of copper. But those almost feel like footnotes compared to the real story, which was the cash conversion.
Okay, so break that down for us, because that cash conversion, that's what's driving this bullish feeling around the stock right now.
Absolutely. So Barrick posted a record operating cash flow of $2.4 billion.
Wow.
And if you drill down to what's left after all the spending, the free cash flow, it was a phenomenal $1.5 billion for one quarter.
$1.5 billion.
Yeah. And when you're generating that kind of liquidity, you have so much power. You're not just reacting to the market anymore. You're in control. And that cash is exactly why they felt confident enough to make these big moves on capital returns.
I see. That makes sense. That kind of cash changes the entire game.
Okay.
Before we get to those returns, let's touch on costs really quick. All-in sustaining cost AISC for gold was $1,538 an ounce.
Right. And that tells you a couple of things. One, they benefited hugely from these record gold prices, right? It let their EBITDA jump 25% just from the last quarter. But it also shows they're still fighting that industry-wide cost inflation. Nobody's immune. But, and this is the key part, compared to their peers, Barrick's quality assets put them in that lower quartile globally. Their margins are just structurally better.
So they're managing inflation better than average.
Way better than average. Which brings us right back to capital allocation.
Exactly. You generate that kind of cash. It shows management is confident. And they really didn't hold back on sharing it.
No, this wasn't just a standard little bump. This was a statement. They raised the base quarterly dividend by 25%.
A full 25%.
Up to 12.5 cents a share. And then you add the performance piece on top of that. So the total dividend for Q3 was 17.5 cents. It's a huge signal to income investors.
And it didn't stop there. They doubled down with the share buyback program.
They did. Added another $500 million to the authorization. They'd already bought back about $1 billion worth of stock this year alone.
So the total program is now $1.5 billion.
Exactly. And when you see a company buying back its own stock that aggressively, while also jacking up the dividend, they're basically screaming at you, we think our stock is cheap.
So the big question for you, the listeners, how are they paying for all this? Is it just that free cash flow?
It's a combination. It's the operating cash flow, yes, but it's also the money they're getting from selling off their non-core assets.
Portfolio pruning.
Right. They're expecting about $2.6 billion from asset sales this year, places like Hemlo and Tungon. So they're selling off lower margin assets and using that cash plus their operating cash to fund these huge returns. And the result, they ended the quarter with net cash on the balance sheet.
That is just textbook capital discipline. Now, here's where the story gets, I think, a lot more interesting. All this is happening right after a big leadership change. Mark Hill is the new Interim CEO and COO. So what's the plan? What are they trying to fix?
The new mandate is all about one word, consistency. Hill came in and immediately started this bottom-up operational review. And the whole point is to stabilize things, to get rid of the unexpected surprises that have, sometimes been an issue at their Nevada operations.
We have to talk about the most significant challenge they mentioned, which is a really somber one. Safety.
It is. The call highlighted 3 recent fatalities. It's a devastating human cost, and it's clear the new leadership knows they have a massive task on their hands to fix the safety culture.
They said the goal is zero harm.
And they have to mean it. The interesting thing they discussed was this realization that while their injury rates have been going down, which is a lagging indicator.
A lagging indicator, meaning it tells you what already happened.
Exactly, a casualty count. But the risk of these major fatal incidents was still there. So they realized they needed to shift from looking at what went wrong to preventing it in the first place.
So that's the shift to leading indicators. For our listeners, what does that mean in practice?
It's like a pilot's checklist. Instead of just tracking crashes, you track how well the safety checks are being done before every flight. For Barrick, they call them critical control verifications, or CCVs.
So getting supervisors out in the field, not just doing paperwork.
Precisely. They've done over 86,000 of these checks this year. But the focus now is on the quality of those checks, making sure supervisors are actually coaching people. For an investor, you should care because a safe operation is a predictable one. Fewer accidents mean less downtime.
And unpredictability was an issue this quarter, right? That unplanned downtime at the Carlin Roaster.
That was a perfect example of why this review is needed. It was an issue with excessive scaling, which is basically a maintenance and process problem. It forced a shutdown. Management was very open that this showed some gaps in their planned maintenance.
Got it. But even with that, overall performance was still pretty solid.
It was, which just shows the underlying strength of the assets. Gold production was up quarter over quarter. Cabali, Cortez, Turquoise Ridge all did well, and Pueblo Viejo in the Dominican Republic, it hit a record for throughput.
Which let them stick to their full-year guidance.
Yep, they confirmed they're on track for both production and costs, even with higher royalty payments because of the high gold price. That's the kind of consistency they want to see everywhere.
All right, let's pivot now to the future, to the growth pipeline. And that seems to be anchored mostly in North America.
It is. Over half of their production came from there in Q3. And the long-term story, it really rests on the 4 Mile discovery in Nevada.
So what's the latest on 4 Mile?
The updated assessment confirms it's one of the biggest high-grade gold discoveries of this century. It's got grade, it's got scale, and it's in a safe jurisdiction. It's the whole package.
And are they putting money behind it?
They are. They're upping the exploration budget, and the big step is they plan to start decline development in late 2026.
So digging the actual tunnel.
Right, which you need to do to get the bulk samples for a full feasibility study. It's a serious, long-term commitment.
And outside of gold, there's copper. Reko Diq in Pakistan is a monster project. How's the financing going there?
The financing is highly advanced, which is great. There was a little delay on the closing, though. It was tied to a U.S. government shutdown, of all things, which affected one of the lenders.
Okay, so a political issue, not a project issue.
Exactly. Management was very clear. This is just a timing thing for cash flow. It doesn't impact the project's overall schedule at all.
Got it. And back at Pueblo Viejo, they hit record throughput, but now the focus is on recoveries. What's the issue there?
It's a complex metallurgy problem. They're processing a ton of ore, but they're dealing with potential stockpile degradation.
Meaning the ore that's sitting there waiting to be processed is changing.
Right. It can degrade chemically, which makes it harder to get all the gold out in the processing circuit. So they've brought in an independent firm to help them improve their blending strategies to get more consistent recoveries.
Okay, before we get to our last segment, there was one kind of weird footnote in the report. This small hedge they put on.
Yes.
The collar.
Less than 10% of production, capped at $4,300 an ounce. This seems to go against their whole philosophy. What was the explanation?
So their explanation was that it was tied to a specific, undisclosed strategic deal that didn't end up closing. They said it was a one-off thing, not a change in strategy.
Does that feel a little thin to you? Capping your upside in a record price environment for a deal that didn't even happen.
It does raise an eyebrow, you're right. Analysts seem to be taking them at their word for now because they've been so committed to being unhedged for so long. But it's definitely something you'd watch. If it happens again, then you have a real question.
Right. So pulling it all together, the new CEO is focusing everything on Nevada, trying to close that valuation gap with their peers.
That's the strategy. Stabilize Nevada, advance 4 Mile, keep returning massive amounts of cash, and you attract investors looking for quality, reliable returns in safe places. Okay, that brings us to our not financial advice segment, where we take all this information and spin up a plausible, if a bit outrageous, trade idea for experienced investors.
Look, given the record cash, the huge capital returns, and this new razor-sharp focus on their best assets, Barrick has basically become this premier capital return vehicle that's super levered to gold.
Right. It's a story about their specific execution, not just the industry tide.
Exactly. Which leads to our idea.
The idea is this: going long Barrick stock and simultaneously short a broad-based gold miners ETF, like GDX.
It's a pure relative value play. You're making a direct bet that Barrick's execution and capital discipline will outperform the mixed bag of companies in an ETF.
You're betting that the new management's focus on stability at their core assets will cut down on the operational screw-ups that seem to plague the wider sector.
And you have that structural alpha built in, right? The 25% dividend hike and the giant buyback give you a return that is totally independent of what the price of gold does on any given day. You're betting that Barrick's internal story will beat the industry's general story.
It's isolating the management story and shorting the general industry risk.
A classic execution versus index play.
So to recap our deep dive, this quarter was all about record cash flow, a huge boost in capital returns, and this new, necessary focus on operational stability and safety under new leadership.
And here's the final thought I want to leave you with. Management has paused any more asset sales to focus on the core business, but there's still this external distraction, the ongoing geopolitical situation in Mali where some of their personnel are incarcerated.
A very serious situation.
It is. So the question is, can they resolve that situation quickly enough to prevent it from distracting them from their stated goal of driving all this value in North America? That internal focus versus that external risk. That's the real tension to watch going forward.
That is a crucial point. Thank you for tuning into this deep dive. We look forward to analyzing the next stack of earnings calls with you soon.